Mark, how are you?
Surviving. That's the best we could do, huh?
Huh?
Surviving.
Okay. Well, first you have to learn to do that before you make progress. Most people don't, right? In this business.
Yeah, what an interesting time, huh?
Yeah, and Blake told me you sent some notes over to ForexAnalytix about midweek, and you wanted to come back Friday. So I know that there are things on your mind that you want to talk about during this time period. So I'm going to let you take the lead. What's top of mind for you,
Well,
Mark,
I'd
right
say,
now?
of course, what we all like wrestling with is this is the debt ceiling, and I want to say that. So what? I mean,
Okay.
I know that, just now for the last half hour, you guys have been talking a lot about it, and that's what's been in the headlines and everything. But,
Yeah.
people like us with gray hair or no hair, we've been through this so many times. The U.S. would default. It's possible, but it has to be a small tail risk. While the base case is that what we've seen happen time and time again is for some last minute deal. I think that we should be thinking about first the big incentives, how the incentive structure is. I think both sides have it in their interest to convince their constituents that they're getting the best deal possible. And how do you do that?
Right.
You wait till the last minute. Secondly, I think that neither side can be sure that they won't be blamed if the U.S. does default.
Right.
And be blamed means being punished at the polls next year's election.
Right.
And the third thing I'd say about the debt ceiling is that neither side is going to give up the power, is going to be using the 14th Amendment or getting rid of it completely, because both sides have been able to extract concessions from their adversary, from the other side, by using the debt ceiling as a negotiating lever. And I know it doesn't make America look good, but I want to say that every country has its own idiosyncratic things, like the British royalty or the Emperor of Japan or coalition governments, things that our presidential system in the U.S. doesn't really allow for. But so I want to say that, yeah, we've got a peculiar institution, the debt ceiling. And I think that we should, this is part of the American, like the political, the body politic. This is the way we do things. It doesn't look very pretty. And I think it was like Bismarck that once said that in a democracy, you shouldn't see the way laws or sausages are made. And we're seeing the way laws are made. And of course, it doesn't set right with most of us. We don't like this. It looks bad. But at the end of the day, I think that we can be rest assured that the U.S. most likely will not default, and that this will go up to the last minute. Concessions will be made. And I think that for market participants, we have to think about not what happens if the U.S. defaults, because if the U.S. defaults, we got bigger problems. But more likely, the U.S. doesn't default, and then what happens? I'm thinking that if the U.S. doesn't default, we're going to have a flood of T-bill issuance.
Yes.
Because the government's been reducing the T-bill issuance to keep them below the ceiling. So we get a flood of T-bill issuance, and the Treasury's got this account, like a checking account at the Federal Reserve, and that's been drained down. I think it was less than $60 billion yesterday, and that should be like $500 billion to say $700 billion. So that'll have to be rebuilt as well. And between that and the T-bill issuance, which there's an overlap, of course, then we should expect a little bit tighter financial conditions. And that's sort of the first shoe that drops. The second shoe that drops, I think, is on the fiscal side. That's on the monetary side, thinking about what the Fed's going to do with the tightening of financial conditions. Fiscal side, the cost of lifting the debt ceiling is going to be a cut in spending next year.
Yeah.
So we should expect some fiscal drag. And I suspect that as part of the deal, that maybe that student loan moratorium, that debt servicing on student loans also ends. And that takes money away from savers, from people who are sort of prime age workers, and takes it away from savings, and also then is another drag, fiscal drag. So my sense is that the U.S. economy isn't slowing. It looks like it's going to grow something like twice the pace of Q1 in this quarter. I think the Atlanta Fed, they'll update their data after today's flurry of data, but they were at 2.9%. The market's a little bit below that. Remember, we grew a little bit more than, about, say, call it 1.3% or so in Q1. The Federal Reserve says that the speed limit, the non-inflationary growth of the economy, is only about 1.7. But I think that this is the best the U.S. economy gets this quarter, and then we slow down with this fiscal drag and with the higher interest rates. So what this means, I think, for the
Okay.
dollar is that we've had a big 3-week dollar rally, and I think it's over or nearly over. And that's what my note was to Blake earlier this week,
Okay.
that the dollar is in its last stages, partly because the interest rate adjustment is also at its last stages. And the interest rate adjustment, I think, has really driven this dollar rally for the past 3 weeks.
Okay. All right. So we talk about resolving the debt ceiling and the huge supply of new treasuries that's going to be coming on. And yet you talk also about an interest rate peak. When I look at the TLT here, Mark, this is a proxy for 20-year paper. Would you buy that? Would you buy
I
these?
think, yeah, this is what I'm thinking is going to happen, Dale, is that next week, we've had this some recently strong economic data, and I think that's
Yeah.
over. I think next week we're going to get softer auto sales, softer jobs growth, and so I think that the interest rate peak, I'm thinking, is not just at the short end, like the 2-year, but also here at the longer end of the curve. I think that we've had this big adjustment of interest rates, and that's what's driven the dollar, and that interest rate adjustment is over, or just about over. And the next batch of data, again, we're not only thinking about the auto sales and jobs data next week, but then towards the middle of the month, we're going to get CPI. And I think someone was saying that on the show before, that we should be looking for lower CPI numbers with the base effect and all that. And sure enough, when we get the May CPI, it's likely to fall close to 4%. And that gives us so June then is also going to be a good month for falling inflation. And that's the good news for inflation out here in the first half, probably something close to 3.5, 3.6, something like that for next month. And then the second half of the year, much more difficult because of the base effect. But so I'm looking at some soft economic data, weaker inflation numbers, and that I think helps cap the yields at the long end of the curve.
Okay. So we've had some of those numbers. Wasn't that one of the worst U.S. manufacturing numbers last week, Mark? We've had some weak numbers. We've had good inflation. And you talk about supply. Could the bond market now not be as sensitive to economic data, and it's more about supply, and that rates could go up even if the economy is softening because there's not enough demand to meet the supply, just a pure supply demand argument being flooded with treasuries and crowding out other credit?
Well, seems to be like what I've heard this from other people as well, clients of ours, talking about the huge amount of supply coming. But when I look at the auctions, the government's auctions in the past week or so, while we've been having this debt ceiling looming, very well received. And so I think
The
that
auctions have been.
I
Yeah.
think the auctions have been, so that is to say that the new supply has been easily absorbed by the market. And this is not even, when we talk about the market, I mean not including the primary dealers, because the primary dealers get stuck with what everybody else doesn't want to buy, but everybody else has been wanting to buy the other stuff. And so, yeah, I think that the concern about too much debt crowding out, I think is a bit of an exaggeration. Partly, I'd say, because what the Federal Reserve does that survey of senior loan officers, and what they've picked up is that there's a weakening demand for credit from the private sector. And so, yeah, I'm not so sure that there's much of a crowding out. I do think that going forward, the key, I think, really is the general state of the economy and inflation. And I think that inflation, we're going to have another 2 months, this CPI later in June, and then the printing of the June print in July. And I think that we could see yields pull back 20, 30 basis points before we get to the end of June.
Okay. Yeah, 360 on the 10-year is pretty pivotal. That's where it kind of broke out from. I wanted to ask you, with your narrative in the dollars that we're close to completion, a lot of people thought we might get back up to here, Mark, call it a flat, some type of, that's an Elliott term. Do you think that the dollar turning south and weakening is going to be a positive for things like S&Ps, or a negative, or it doesn't matter?
Yeah, so it's hard for me to think about the dollar in general. I usually see like some pairs of exchange rates more sensitive to the S&Ps than others. So, for example, the
Housing.
Canadian dollar I find has a higher correlation most of the time with the S&P 500 than it does with oil, or than it does with short-term interest rate differentials. Uh,
Okay.
so, so I don't know. I mean, I try to. I get the idea of these intermarket ties and links and things like that. But I typically don't emphasize them, except thinking that the dollar, the foreign exchange, is one dimension of the price of the dollar, and interest rates are the other sort of dimension of the price of money. And I see those two tightly linked. Stock market, different story. But what strikes me is another reason why I say that the debt ceiling is like is a big distraction. Is I thought that the S&Ps and the Nasdaq made new highs for the year either earlier this week or last week, while the debt
This
ceiling
week,
debate is going on. And so I
exactly.
think that yeah, so I think that
Especially the
outside the
NASDAQ. Look at that.
yeah, yeah, I think that outside of the T-bill market, the credit default swap market, which is thinly traded in the first place, I don't really think that the debt ceiling debate has really impacted the markets very much. I know everybody talks about it, but I don't really see it. I mean, I think I can explain the dollar's movement and what's going on with interest rates, especially, say, the 2-year Fed fund expectations, without really talking about the debt ceiling. I think that we get
Okay.
ourselves caught up. I think I got a T-shirt from the last time we went through the debt ceiling. And of course, Fitch's warning about putting the U.S. on credit watch. It's
They're
scary.
Moody. They're Moody's in this cycle, right?
I think it was
From
S&P
2011.
in 2011 that downgraded us. But at the end of the day, it's like, is there really much of a difference between the AAA and a double and a the double A plus or the AAA minus? I don't think so. And I think the
Not on
U.S.
my
Treasuries.
record. Not on my report cards I brought home.
Yeah, and I think that I think that the Treasury market is sort of like what Reagan said. It's big enough to take care of itself, and I just think that we get caught up in these, partly because we like the drama. It helps fuel the markets, but at the end of the day, this is just, like I say, a peculiar American institution, not something to be proud of, but something that we survive, and something that's not the end of the world.
Okay, so what are your price levels that you're looking for here in, say, for example, Euro's close to digging in its heels here. What new highs, 112, 113 euro for the next advance?
Let's put in a low here, some kind of low. I don't know if we've had it yet. I think we're close to it. I was looking at when we show on this
106
chart
level?
here the distribution kind of top we had in the euro, and I kept on looking for lower levels. Now we got that lower level. We surpassed that 107.35, that Fibonacci retracement. Because I was thinking, sort of towards Blake's point, he says he comes up with a scenario that is like sort of his working hypothesis. And my
Right.
working hypothesis had been that we are going to correct the dollar's sell-off, the euro's bounce from that would be the March 15th low, and sterling was the March 8th low. And we've surpassed the euro's retracement about 107.35. And the question, it seems to me, is this the beginning of a new leg down, or is this a false break? And right now, my leaning is to make it to see it as a false break, and that we move back up, we recoup those retracement levels, and that we have a gradual turn here in the turn back up in the euro after having corrected. I think a lot of the good news for the U.S. is known. I think that, like I say, the debt ceiling wasn't really much of a factor here, but I think for me, the interest rate adjustment's nearly done, and now we can begin focusing on, Europe's had a series of weak data. Germany actually revised down their GDP, so they contracted 2 quarters in a row.
Yeah,
I'm
they're
not sure that
calling it a
Germany.
recession, is it?
Well, it's the technical. I mean, the U.S. economy contracted in the first half of last year, and very few of us really think that was a recession. What strikes me, Dale, is that the word recession has no real meaning. I think that Americans invented it to come up with a separation from the Great Depression, to distinguish business downturns after the Great Depression. So they came up with the word recession. But there's no real agreed upon meaning. And even in the U.S., the official arbiters don't use that 2 quarters of back-to-back quarters of contraction to be a recession. But what I'm thinking here is that a lot of the good news for the U.S. is known. Like I say, we should be getting some weaker economic news. At the same time, I think that a lot of the bad news for Europe is known. Remember what happens. They avoid a combination of good luck and
Yeah, the
preparation,
weather.
avoided a winter cycle, a winter
Yeah,
crisis. The
yeah.
markets love it. They rally January, February into March. Then it looks like the Eurozone economy hit a wall. And weak economic data March, a little bit into April. And my guess is they we're going to see some better numbers here in the spring. And so I think that the news cycle, I think, begins also helping the euro, weighs on the dollar.
Okay, so if you think yields are peaking here, Mark, perhaps we're approaching some type of high here in U.S. dollar yen.
Yeah, when it comes to dollar yen, I know people talk about being a safe haven and that, and I don't see that. I just think that the yen is often used as a funding currency because unlike retail, on the retail side, when I'm thinking about my own money, I'm thinking, what can I buy that's going to go up? Or what can I sell that's going to go down? But I think the way institutional money thinks about it is they're not going to use their own money. If they're going to buy something, they're going to borrow money to buy something else. What do? They borrow the yen, they buy some high yielding or high volatile asset. And when that asset goes south, which it invariably does, they buy back the yen and voila, safe haven narrative. But I really
Okay.
see the dollar yen driven by interest rates. And so my target was this 139.50, 140 area. We got above it in very thin trading in the US yesterday. No follow through in Asia and Tokyo last night. And I think that I think that if this doesn't hold, I think we got to almost 140.30. If that doesn't hold, my next level is 142.50. But I'm thinking this is going to hold in this general area, lower interest rates. The Bank of Japan is still reluctant to change policy. It's not just Governor Kuroda, who is like insisting on a steady policy. The new Bank of Japan team has also been reluctant to change policy, but the market's still betting that there's going to be a change in June or July, a tweak of policy, weakness of the yen, the higher underlying inflation measures, strength of the Japanese economy, all favor some kind of action in the next couple of months from the BOJ. So my sense here is the dollar yen is near a top. If this 140.30 area holds or so, I think we work our way back down. If it doesn't hold, next key level about 142.50.
Okay, interesting. I know that currencies are your bailiwick. You looking at any outside markets besides currencies, and do you pay attention to silver? I mean, it's the color of our hair. Do you pay attention to it, buddy?
A little bit. I feel gold a bit closer. I think that with the central banks buying gold, though, I would point out that the IMF's measure of central bank gold purchases aren't quite as optimistic as the World Gold Council, the industry association. But here, I think if you tell me the direction of the dollar and the direction of U.S. interest rates, I'll have a good guess at what's going to happen to gold. I saw us go through that 1950 area. It has found support. I think the dollar pullback, softer yields can help us reclimb back up towards that 1980, 2000 level.
Yeah, 2000 looks pretty key.
But one currency though that I see you don't have listed there that I sort of like, it's really been one of my favorites this year, but it's been squeezed lately, is the Mexican peso. Imagine this. They pay 11.25% overnight rates. They're on hold now. And it's still what an incredible pickup. Plus, the Mexican peso is, if not the strongest emerging market currency this year, it's the second most. We had as you see, you've got the chart up here.
Which is the real? What's the strongest one? It's not the real, is it?
No, it's been sort of back and forth between Mexico and Hungary, which also has very high interest rates. But I like the Mexico story. A lot of the big investment themes, the narratives, all like come together in Mexico. You've got the high yield, and for carry trades, you need low volatile currency, and the Mexican peso is among the least volatile of the major emerging market currencies. So high yield, relatively low vol, and it's a 24-hour-a-day currency, the only emerging market currency at 24 hours a day. Plus, you have the nearshoring, onshoring theme of the sort of this era now, I guess, post-Russian invasion of Ukraine. And Mexico benefits from that. And that's seen through two channels: direct investment, companies building new factories in Mexico, and it's seen through the equity market, which is one of the strongest equity markets among emerging markets this year. I think it's up about 14% or so. On top of that, what we're going to get is in Mexico, it's an amazing story. Even though they have a trade deficit that was reported yesterday, Mexican workers working outside of Mexico, like in the United States, send money home to Mexico every month. And we're not
Yeah.
just talking about $100, $200. It accumulates to something like $4 to $5 billion a month, which more than pays that is to say, more than covers its trade deficit. So Mexico is a great story. It's had a nice setback here, partly on the rate decision, partly on some risk off, partly on some local politics stuff about whether Citibank's going to sell its branch network or what. Bottom line here, Mexican peso is weakened, and this, I think, is a new buying opportunity for the peso. Given its high interest rates, it's very expensive to short.
If you were, say in your 20s or 30s, and you just heard a guy, like you just say that about Mexico, would you move there?
Nope, I think that's the real problem. I think you hit the nail on the head here. I like our civil liberties in the United States. I like my freedoms in the U.S. I like my mobility. I like the English language, the only language I can operate in. And so I think that, of course, I think that your point is also very much, I think, to China. People say, well, if you like China, why don't you move there? It's not like I like China. It's just that I don't think China necessarily is the devil incarnate the way our U.S. media often makes it seem. And so I do worry that we act as provocateurs often towards China. But I wouldn't want to live in China. I need my civil liberties. China still is an authoritarian, if not totalitarian regime. So we can like the currencies, we can like investments, but no thanks. I'd like to stay here in the States.
Right. It's all about being content. And Mark, you talk about China, and, I agree. Right now, we're making a big deal out of them banning micron chips. But most Americans don't know that we already have, trade restrictions on them to get no chips. So it's not like they're the aggressor. They're just retaliating to what our actions were.
Yeah, we have seen. So for me, a lot of people say, well, China manipulates its currency, and it does. It's highly managed currency. Exactly how they do it is just beyond me. I think that they change. It's almost like one of those Star Trek shows where they fight the Borg and they have to keep changing their defenses randomly. And I think that China changes how it manipulates, how it manages the RMB. But it seems to me that if I want to, as a market participant, I don't really care so much how they do it. What I'm mostly interested in what they're doing, and I sort of see the Chinese tracking the euro and yen. So if you tell me which way euro and yen are moving, I can have a good idea which way the dollar is going to move against China. And it's not coincidental that this week dollar yen made a new high. Dollar yen made a new high for the year, and so did the dollar against the RMB. And I think that when the dollar yen and the euro find some support, I think the RMB can recover as well. We've got a big policy divergence data. We talk about our inflation coming down. China's CPI year over year 0.3%. We could take Chinese data at face value. Bond yields, the U.S. offers almost 100 basis points more than China. So I think there's good reasons to be doubtful of to understand this Chinese currency weakness recently. But I think it's largely not China doing it. I think China's just tracking the euro and yen. And I think that when the dollar sets back, we'll see the RMB recover as well.
Okay, Mark. Last thoughts going into the Memorial Day 3-day weekend?
Now, remember, Monday's a holiday in the UK as well, so there's no real liquidity outside of Asia come Monday. Big focus next week, I think, is going to be on the US data, the jobs data, of course, the debt ceiling. But like I say, we should expect some more drama. President Biden said he wasn't going to talk and negotiate about the debt ceiling, and that was part of the negotiations. Saying you won't negotiate is part of how you negotiate. And just because they begin talking, it doesn't mean the drama ends. It means that the drama there's another act. And I think that we still have a little bit of time, and so there'll be a little bit more drama, I suspect, in the early part of next week. The only thing I really would end it with is just to remember that trends are your friend until they stab you in the back.
Spoken from a guy who spent some time on the floor.
Exactly.
All right, Marc Chandler, great to talk to you. You could follow Mark at Mark Making Sense with an S, and your website address for people to go there, Mark.
Mark to Market comes from the first book I wrote, Making Sense of the Dollar. And so Mark to Market. Every day, my employers let me post a commentary up there. And I appreciate your help on ForexAnalytix, posting the commentary too. Doesn't have to be read on my site. I just want to participate in the broader discussions. So I appreciate your support.
And Mark, we're fans. We root for you, and thank you for bringing some clarity and making me feel foolish for getting caught up in the debt limit debate and making predictions about what's going to happen. Anyway, always a pleasure, Mark. Thank you so much, buddy.
And good luck to everybody.
Yeah, have a great summer's coming up. We're a month away. Rooting for you and everyone your words touch. Happy Memorial Day to everyone out there, and especially to the families of the fallen. There is no greater love than one laying down their life for another. So whatever your politics are, you have to be for the troops. So happy Memorial Day, Mark.
Well, good luck to everybody. Thank you.
All right, that's a wrap, everyone. We laid it on the court for you. Hope you guys had a good week. We added value. You have 3 days to think about what your next step is as a trader as we get ready for the summer trading season. You know what I think the step you should take if you haven't already, so I won't even say it. Have a great holiday, everyone. And don't just count your pips, count your blessings. And we'll be here Tuesday. Enjoy your long weekend.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.